How did the name Motilal come about? Because there is a story that there was a badge handed out to you.
It's a 15% market. Try to be a good seller rather than a good buyer at all times. So we want to give very sustainable returns.
Because even power of compounding only comes when someone is strict to the process.
You got to stay with the manager in the house when they are not doing well.
Welcome to the Germinate podcast. We're so glad, and literally it's an honor to be with all of you here at the Motilal Oswal Tower. You know, we're shooting not from a swanky podcast studio, but we are at the heart of the action, which is the Motilal Oswal Tower, and with the founder and the senior management of the team at Motilal. We're so glad that you're tuned in, and I'm hoping that the next few minutes that you spend with us will be absolutely informational and adds the power of compounding to your wealth creation journey. Let me kickstart. Sir, thank you so much. You know, there's a lot of history and legacy to the name Motilal Oswal and the organization that you built. You know, we're sitting in a tower that stands as a testimony to what you guys are and what you guys have built. It's phenomenal. In fact, when you come into this part of town, you can't miss the tower. And you're a towering personality. And I must say, you are the Warren Buffett to India for most of us. It created enormous wealth. My question to you is very simple. How did the name Motilal come about? Because there is a story that there was a badge handed out to you. You want to share some story about that?
Yeah, so that is the story. In 87, when we started going to the ring, I mean, we were sub-brokers to Sundarayar. And Sundarayar, I mean, you have to take one of the 6 batches of the main broker. So between me and Moti, we decided that Moti will go in the ring and hence the badge comes in his name. Now, in 3 years' time, we were ready to buy the membership. So when we bought the membership, there is a qualification that you have to have 3 years of experience in the ring. Okay, I had 0 experience. He had the experience. So obviously, it had to be bought in his name. And second, there was another law, unless you're a blood relative, you couldn't be a partner. So it had to be a proprietary concern in the name of Motilal Oswal. And that's how Motilal Oswal came into being. We're going to change the name in 96 when it became corporate, when the law became much more liberal. Then Moti said, should we change the name? I said, I don't have any problem. I don't want my name to be there. So we would have done some Prudential or some Fortune or something. Instead of that, Motilal Oswal doesn't sound badly. So why disrupt this? This damn thing works. Let it go on. That's how it is continuing.
So there you go. You created a household name for all of us. So the other thing that I want to ask you is that you said you started 87. You know, today as we speak in 2024, towards the end of the year, almost 50% of our retail investors have come in 5 years or less.
Right.
Someone like you who started in 1987 and seen a whole lot of market events. How do you read this present time where so many of the investors have come on the back of so much money being made in such quick time? I'm sure you've seen more cycles like these. So you have a message for the retail investors who've just come?
Yeah. So the message to retail investor, not retail speculator. Please be very clear. Because a lot of times the people who ask questions, they don't differentiate between a speculator and investor.
Retail investor.
So if you invest here, see the last 5 years also you have made 15% only. Exact 50%. If you see the index Nifty, it has done 15%. It is up 100% in last 5 years. Okay, if you do exactly 5 years. So this is the market for last 5 years, 10 years, 15 years, 25 years, 40 years. Right from 79, it has given 15%. So it's a 15% market. Okay, now if you're, and nobody makes 15%, let me tell you. Most of the retail, they don't make 15%. That's why it is important that the compounding power of coming to equity markets has been missed by retail for a very long time. And they started coming 4 years back. This is game changing, not for the retail investors. It is game changing for the markets. It is game changing for the economy. This is game changing for the nation itself. But it is only 4 years. Just look at out into 10 years. This is the first order effect what you are seeing. The money starts seeping into the economic system, to the industries, to the companies, the entrepreneurship confidence. I mean, today, if you have a good idea to your 2-3 guys, like me and Motilal Oswal, we couldn't get even a lakh rupees promotional money. Today you can get $1 million, $2 million seed money. That is possible. So that is what is going to change. And entrepreneurship will thrive. Very long-term change. But in short term, yes, there is an impact in the market. It has become very, very wide, broad, deep, and liquidity is massive. So I think it has become an international play. We trade about $7-8 trillion a day. We used to trade 200 crores
Yes.
in 87. It has gone up by 2 lakh times.
I want to follow through with one question. Now, here you've told that nothing to worry about the just last 4-5 years of great run we've had. There's more to come. For the benefit of retail investors, and especially the guys who thought this 4-5 years is just too good to be true, I know you've spoken a lot about the power of compounding that can benefit the retail investor. Now, one is to calculate it, one is to perceive it and know the power it has to change one's wealth in a lifetime. Would you want to just take a moment for the benefit of all of us to explain that?
Rule of 72, 72 divided by percentage gives you number of years in which you double. 72 divided by percentage gives you number of years you can double. Okay? So, how it goes? At 25%, 72 divided by 25, in 3 years you double your money.
Right.
3 years you double money. In 6 years you go. I'll teach you now.
Yes.
Okay.
I'm scared.
In 3 years it doubles. In 6 years what will happen?
6 years it goes 12.
How?
4.
You go 4.
Okay, 625, yeah.
See, you have to have compounded thinking also. And 9 years what will happen?
So, years may double, so 9 years.
So 9 years, 18.
8.
Okay.
2, 4, 8. And then 10th year, it will
16.
be, no, it will be 8 into 1.25, that will become 10.
Huh.
So in 10 years, 10 times at 25%. In 20 years, what will happen?
100 times?
100 times. You got it. Okay? And in 30 years?
1,000 times?
1,000 times. In 40 years?
1 lakh
10,000 times.
Okay.
You know, and 50 years. So most of the guys, they are going to work for 50 years. So you can do 1 lakh time of your money, whatever money you put in. You start with a crore, you can be 1 lakh crore at the end of 50 years. And it just happens. It will happen. This is a power of compounding. This is simple maths. But understanding people, people knowing that you can see your future actually. Whether you do it 15%, 25%, 35%, Rakesh Jhunjhunwala and all, they did it 30, 35%. So now second thing is, at 25%, in 10 years, it goes 10 times. At 35%, what happens? It goes 20 times in 10 years. And at 45%, it goes 40 times in 10 years.
Wow.
And that's why the power of digital companies. Why
Correct.
I say that. So stay onto that kind of a concept. So it is very important to understand power of compounding, even for investing.
Correct.
For your personal wealth, for seeing the future of your financial independence. Because you are working for what? Financial independence of the people. So people don't know that they are financially independent. After investing 50 crores, 100 crores in the markets, you are done. You cannot consume that money. It will create so much of money every year.
Absolutely. So I think you've given us great encouragement to stick in the game. So Niket, coming to you. When he said diversified basket, you're the one who's now managing maybe diversified set of schemes. Normally, I would say, what is your success or what is your mantra? But I think I'd rather ask, how do you work every day with a person like Mr. Raamdeo ji with you? And, when we talk about Motilal and maybe the Motilal funds, there is just this natural thought in people's mind. They're saying that I will make my money because these guys know equities well. And there's this famous campaign also that you had, which spoke about the strength that you guys have in equities. How do you manage your day-to-day job, knowing that this is the expectation you have?
First of all, everyone in Motilal Oswal gets a lot of freedom. There's a concept of entrepreneurship. So everyone has a reasonable amount of freedom of how he wants to grow it. And then there are clear guardrails, right? So we follow a QGLP philosophy. Till the time anyone and everyone who's following a QGLP philosophy is free to buy whatever stocks or sectors he really wants to navigate till the time you're following that philosophy, and then there is no deviation from that philosophy. Second, I think the most important part starting from a Dave standpoint, obviously a large part of my day goes to manage my own funds because I also manage 4 funds. But I think 2 things are quite important for us. One is the culture, right? We are an extremely meritocratic organization. It doesn't matter whether it's a junior guy or senior guy, everyone has equal amount of views that everyone gives on a day-to-day basis. We have a 1-hour meeting every day with the whole IC, and everyone is free to sound their opinion. Whether it's a junior guy or senior guy, really doesn't matter. So we have the culture of pretty much like a startup in some sense. And we want to be quite flexible in the way we really operate. There's no structured format as such. About 15% of my time, I keep it very unstructured for the day. So I would walk up to another fund manager, discuss something, walk up to a team member and discuss. So 15% of my time of the calendar, I tend to keep it free. And balance most of the time also goes towards hiring, compliance, ensuring that most of the other funds are also rightly positioned as far as being ahead of the curve is concerned, right? So whether it's sectoral allocation, whether it's stock allocation, have to ensure that other funds are also synchronized in the same direction so that the organization moves in the same direction with the same. So for example, digital is a large theme that we embraced pretty earlier. Right. So most of the funds have very large allocation to digital. It's not that one fund had very high allocation to digital, other at zero, right? So we have, ideas for the house, right? Whether they might be themes or they might be individual stock ideas. And when there are themes which are discussed in the IC and everyone approves it, everyone moves in that same direction.
So let me ask you something here. Considering that you have autonomy to run and there's so much of meritocracy here, do you have any incident of how you used his wealth of knowledge and his experience to solve maybe something that you couldn't solve yourself, or how do you plug into it? That's be exciting to know.
No, I think, RA is always around for the philosophy standpoint, right? So anything, I think the most powerful philosophy is QGLP, but even more tougher is to follow it on a disciplined format, right? It's very easy. I mean, if I tell you what is QGLP, you would also understand, but it's very difficult to do it on a day-to-day basis, right? So it's all about execution. You just have to keep your head down, execute. And I think that's what we are all up to, right? So if you continue to do the same thing in a disciplined format, outcomes are in front of every one of us, right? So I think a large amount of outperformance in the last 4 years is just following QGLP to the last decimal point. No deviating here and there, no compromising on growth. And obviously you try to innovate, right? Try to be a good seller rather than a good buyer at all times, right? So good selling is quite important. You have to exit something and then move on to the next one, because we are in business of giving sustainable returns over a period of time, not giving very good returns in 1 year and bad returns in the next year, and again good returns in the third year. So we want to give very sustainable returns to investors who come to Motilal Oswal thinking that these guys will be in the first or the second quartile over the longer duration, and we will not see negative surprises with them, whether it's a bull market or a bear market. So I think if we continue to follow the philosophy broadly, I think I've seen we will be in good shape. And there are years where we've not done well. And if you backtrack the data, we would have actually seen that, that philosophy was not followed to the last decimal point. So whether we would have bought a stock, you thought that this company is going to grow at 25-30%, but actually grew at only 5%, right? So in some sense, the G part never came as far as QGLP is concerned. So Q stands for quality, G stands for growth, L stands for longevity of the growth, and P stands for price. So if you miss out the G, then pretty much the returns are quite average, right? And then you tend to underperform. So if you tend to follow the philosophy, then I think there's no worry at all.
When we look at process that Nikhil just spoke about, and we also have good people, merit-oriented people to manage this. It's not natural that if you stay invested for long enough, that the performance will come through. Now, this is sometimes very differently understood by the investor, because most of the investors are at some level chasing performance. How, in your experience, these 2 points, how do we, kind of further help our investor understand the process and the people are such integral parts to good outcomes? Because even power of compounding only comes when someone is strict to the process and the people are doing a good job at following and even enacting the process.
As an investor, I can say that one thing is that what is the track record of the house? What is the track record of the person who is managing? The scheme also has some track record. So if in general you are comfortable with the house philosophy, that QGLP philosophy, are you broadly comfortable or not? Second, this guy who's managing money, because ultimately money is going to him, and it's a very broad parameter of QGLP. Whether he's actually observing him, and he can say in your podcast, I'm doing it. But you go and check. See, that is the research you have to do, whether he's following it or not, and ask very sharp questions before actually pumping money. That investor cannot do, you have to do it.
Yes.
Okay, you are making tall claims, but are you following? So you have to ask that. So he keeps on the same, path of that thing. And once that is there, rest all will happen because of the power of earnings growth, power of the economy, power of India, where India stands. The most important thing is the compounding happens not because of us. Compounding happens because of the economy and corporate earnings growth. So if the corporate earnings don't happen at 14-15%, there is no hope in hell that sustained way you'll make it. Yes. There could be a flow of money and market can rise by 40-50%. But again, it will slump if there is no corporate earnings. So I think the mother of everything is corporate earnings, and that comes because of the economy, not because of us. Our job is to find where exactly the corporate earnings are accelerating and market is behind. Or market is not understanding power of compounding of that particular growth. Is market taken care of in terms of compounding? So that's where I see many times opportunity. And that's what the active manager's job is, to be ahead of the crowd and put the bets where extraordinary growth is going to happen. Quality of the company is not in compromise at all. But there is a company which may grow 5%, other company can grow at 30%. And both might be priced same, incidentally. So where do I go and put disproportionate bet. So I think that's what they do. And that's how the machine works.
In fact, we've coined this term called HTI, the high trustworthy individual, because normally we categorize investors as HNIs, high net worth individuals. But for every high net worth individual, we need high trustworthy individuals like yourselves over here that people can trust their money with. And therefore, at Germinate, we do take that extra step to figure out whom to partner with and whom do we work with.
And let me tell you, the real thing is you got to stay with the manager in the house when they're not doing well.
Absolutely.
Because the necessary part of the compounding is there'll be down days. And in the down days, you've got to be staying. Don't break that compounding. The compounding doesn't mean up, up, up. Compounding also means you can be, say, if you're 25% compounding, in a year you could do 50%. Then that doesn't belong to you. It will, the reversion to mean will happen. And when it goes to the reversion to mean, it will be underperforming, not performing. That time, don't go away from the show. Because you cannot...
The advice you're giving is almost like a permanent tattoo we need to do so that we don't forget this news.
Yeah, so you have to stay on. Because the purpose for which you came in, you like Motilal Oswal, you like Niket, you like this scheme, you like the theme. Everything is right. But he also can underperform while everything is right. At that point of time, you have to stick on. And that's why who makes money in the companies? The owners of the company. Because the owners of the companies have no choice. Businesses go through a good time or bad time.
Yes.
You have a choice to be there as a fair weather friend, but entrepreneur doesn't have a choice. And that's why when the good times come, they are the only guys who make money.
Correct. So
I'll also make another point because you just
please.
alluded to the point that how the house really manages when the funds don't do well. And I'll narrate a small story. So when I took the fund in July 20, the fund was underperforming by 15%. I took the first fund, which was the mid-cap fund. And that 15 actually, because while we were making changes to the fund and the market is also going up quite fast, the fund actually went from negative 15 to negative 25, right? And at that point of time, we used to have monthly reviews, right? Because they were unusual times and Raamdeo used to have monthly reviews. And I used to actually keep my Zoom camera off. I said, boss, kya shakal dikhenge negative 25? But at all points of time, Hare never used to give you a peace of mind. Ki, yaar, kya kar diya? He always used to say, are you following the process? Right? Just keep following the process and the magic will function one day. And actually, we kept doing that and we didn't even realize, last week itself, during Diwali, we were speaking to a couple of fund managers within our office. We're just thinking, suddenly, kahan ban gaya? 1,20,000 crore, kahan se aa gaya? Pata nahi chala. Right? So the idea is that you keep executing over a period of time. And the second thing is, I think with Raamdeo ji is everyone in the team can really walk up to him, can give him this idea, and he's always a very good listener, right? So even a junior guy can walk up to him. That's his greatness. That anyone in the team can walk up, say, "Sir, aisa nahi hai, aap jo bol rahe ho, mujhe lagta hai aisa hai." So he will give a very patient listening. He'll definitely think about it, and then obviously give him his advice. And last but not least is discipline. While we can buy a right stock and try to time it and sell it at the right point of time. But the real essence is that how do you, navigate through that stock in a bad patch of that stock, right? There are companies which will grow at 25% for 3 years and then that 4th year, they might not grow faster. And again, 5th, 6th year, they do well. But the 4th year of lower growth, hai, how do you navigate through that period? Do you exit it? Do you hold on to it? Right? Do you believe in that management? Do you believe in the longer term story? So I think from that standpoint, I think the discipline that Raamdeo ji brings on table, I don't think anyone has that patience and discipline in entire India. Which he possesses. There are companies where expect grow at 25%, they've grown at 15%, and we would have said, "Arey yaar, sir, 15 se grow raha hai." He said, "No, just hold on, don't."
No, you bring a very interesting lesson here. There are two people in the equation that need to be disciplined. One is you guys are disciplined to the process. I think the takeaway here is that the investors also got to be disciplined to the time horizon.
Yeah,
that is through the performance cycles and through the market cycles. I think that's a great takeaway. That it's not only the fund manager who needs to be processed and disciplined, but even the investor needs to be, in the game for as long as possible. I'm going to quickly swing to Prateek. It must have been an effort to convince the people on the other side to be known so much for active equity, and we are the forefront of, our capital markets evolving. You're one of the few that had early success with, passive investing, and those strategies are actually now become integral to clients' portfolios. How did that thought process come about, especially from a fund house like yours?
I'll be honest, it was a bit of effort to convince me.
I think so.
It was the opposite. I think Raamdeo ji, so I used to be a wealth manager in my previous avatar. I used to be in the US. and I was exposed to a lot of HNI clients. So I had about 800, 900 HNI clients. And when I saw their portfolios, they had about roughly 40, 50% passive, 40, 50% active. They had some quant strategies. They had international funds. They had factor funds. They had options in their portfolio. So we used to provide option portfolios. So when I came back to India in 2018, I thought that all of this stuff is not there. So how do you look from first principles? And we know that there is a bit of a lag between India and US. So the idea was that how do you create innovation in the industry? Back then it was only long only portfolios. Back then passive used to mean just Nifty and Sensex. So the idea was can we broaden the definition of passive? Can we add more sort of P&Ls into the MO umbrella? And honestly, I think most people ask me that was it difficult? Actually, it wasn't very difficult. Motilal Oswal, in my view, has been one of the most sort of innovative organizations that is there. I might be biased, but that's what I've seen. Focus strategies, where we have been pioneers of. AIS, where we're market leaders. So I think innovation is sort of in our DNA. And I think we believe, at least I believe, that innovation comes from experimentation. So the idea was to come back and sort of, see what we can do in this space. We believe that, when we did start our, AMC business, I remember 2013, I was part of the organization. People were like, you guys are brokers. Why are you guys doing AMC? Why are you guys doing funds? When I joined the organization in 2018, they were like, "Why are you guys doing passive? You guys are active guys." So I think the crux of what I've learned is that we stand for equities. Our tagline is "Think Equity, Think Motilal Oswal," and equities is not long only equities. It's not broking. It is active, passive, quant, a lot of other things that we are working on also at this point in time. So I think that's the philosophy, is to make sure that customers' preferences change. And the reason why, as an organization, we've also shifted from a mindset 20 years ago versus where we are. I think we have to be in line with customer, the preferences, and that's where passive comes in very strong way. In fact, we actually failed in passive. The first time we did passive in 2009 to 2013.
Too early.
So I think what we've learned is when you're early, you have to be lucky or patient. So we've had to be patient in this business. We have been lucky in the last 5 years. We've been innovatives in international funds, factor funds, broad-based passive funds, also thematic funds, and also now quant funds as well. So the idea is more towards I think offer compelling products for investors within different sort of domains in equities, and so far it's been great.
So while you started the whole passive business early and you had to be patient to taste success, and today's success is in more ways than one. Not only has a passive business grown, but the industry is caught up. In fact, in the year 2024, we've seen so many passives come with specific themes and ideas, which has given the investor the luxury to participate in certain themes and exposures, which were earlier not there. Now, the direction that this is leading us to is that how big is passives and the entire ETFs going to become? And is there an inflection point that you foresee now?
I think passives, if you look at passives, in at least my opinion, it's still very small. I think passive tends to hog a lot of limelight, a lot of media, press, PR. But if you look at the overall passive exposure in India, it's about 12 lakh crore. And out of which, equities will be approximately 9.5 lakh crore. Out of which, there's one single investor who's about, 80-85% of that. So we believe that passive is still in the very early stages of growth. We believe that passives is currently being very well accepted by institutions, family offices. In fact, what we did is very interesting. In 2019, when we first started of thinking of building passive, I did some market research, and back then 99% were institutional. So we took a bold call back then to not focus on institutional. So we didn't have an institutional team. We only focused on retail. And that actually turned out to be very good, because if you look at today, 30-35% of the flows that come in through retail actually comes to MOMC. So I think it's still very small. We believe that in a country like India, where inefficiency still exists, passive offers a lot of simplicity in people's portfolios. I think a lot of people who really don't have the time or the expertise to figure out which fund to buy, which fund to sell, for them, passive offers a lot of simplicity. If you're looking to invest for the next 30-40 years, which mutual fund are you going to buy? So a lot of DIY customers tend to lap up on passives. But that's more of traditional passives. We believe that there's a lot more categories that have come in, like international, fixed income, factor funds, which is more distribution friendly, which is more lapped up by all sorts of investors. In fact, what's really shifted in our business in the last 5 years is that 5 years back, 80% was completely direct. So direct was very small, and we had 80% of that. Today, about 70% is actually through advisors and distributors. So I think it has been very well accepted. We believe that the base is still very low for retail and audiences, and it will only grow over time. And what we realize is that innovation is very important in this space. When people look at passives, they look at efficiency, they look at track record. We've been very aggressive, and also most importantly, I think efficiency is the most important. So how much ever sales or marketing you do, ultimately people who make a choice about buying passive do it on the basis of something called tracking error. So I think still a while to go before any sort of, but we believe that the base is still very low and it's growing very quickly.